Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenevec and Katie Greifeld. We're live in the Bloomberg Interactive Brokers Studio in New York. In just a few minutes, I'm actually going to get to interview Katie on one of her recent columns.
Does that mean you read it?
Yes, it does mean I read it.
You have, I think, a few minutes to get up to speed.
It's all about the R word. We're talking recession here. We did not hear Jay Powell actually say that the U.S. is going into recession. But we got some hints of how he's thinking about things.
He got close.
He did. He got close. Thanks to a question from Mike McKee.
Yeah, great guy.
That in just a few minutes. First up, though, let's get over to Doug Krisner with a market flash. Hey, Doug.
Hey, Tim. I think it's safe to say at any rate that markets seem convinced that the price for getting inflation under control will be recession. Equities are on the defensive in a big way today. S&P 500 very near the worst level of the day. We're down about 2.7% right now. It's energy leading this decline. WTI crude oil is weaker by nearly 6% right now. We're trading 78.65 in the New York session. Dow Industrial Average off 2.5%. NASDAQ comp down about 2.7% today. You remember that as a part of the Fed's forecast for Fed funds, rate at the end of the year of 4.4%, that would imply an additional 125 basis points in tightening before the end of the year. Today, we've got a 2-year Treasury up by more than 7 basis points in yield at just under 420. On top of that, a lot of concern about the direction of the British economy. The UK government today announcing its most sweeping tax cut since 1972. Yes, these measures are intended to stimulate growth, but they come at a time when the Bank of England is trying to rein in inflation. Look at the yield on the UK 10-year, up 33 basis points to 3.82%. The U.S. 10-year now at 3.68%. We are down, actually, by about 3 basis points in New York trading. I'm Doug Krisner, and that is your Bloomberg Business Flash.
Hey, Doug, thank you so much for that Business Flash. Really appreciate it. Well, I mentioned that each and every Friday, Katie Greifeld has a newsletter come out. It's called The Weekly Fix. This week, you wrote about a lot, including the potential of the U.S. going into recession and the way that Powell addressed that on Wednesday. But you also wrote about bonds.
Yeah, I try to pay some lip service to other parts of the fixed income market. If I wanted to, if I was left to my own devices, I would probably write 1,600 words straight on just what Treasuries did. But there are some interesting credit stories out there, and I was crunching some numbers, which is very difficult for me. I'm not a really good user of Excel or even the terminal.
But you love writing about bonds, so that kind of doesn't make sense.
Yeah, I have a lot of really patient strategists that I'm friends with who help me do things. But one of the numbers I came across this week was inspired by basically listening to Michael Collins. He's a portfolio manager over at PGIM. He was giving an interview on Bloomberg Television where he said that we're seeing bonds across the board, across all our portfolios, trading at big discounts to par. And as you know, as long as they don't default, they end up back at par. So I went on a little journey to find out, actually, if you look at the U.S. investment grade bond market. Is
it a bargain bin?
Yes, it's crazy. About 88% of all the bonds in a Bloomberg index of investment grade bonds are trading below par. And if you look at that number, if you run that exercise this time last year, that number was just 4%. So it really speaks to this widespread, this huge magnitude of a drawdown that we've seen across the fixed income spectrum, but particularly, again, in blue chip bonds.
So what does that mean for investors right now? Is it that...
It means you've lost money.
But does it also mean that if you're looking to get in, now could be a good time?
If you're a brave soul, for sure, now would be the time. Again, PGIM made that point. He said, Michael Collins, again, a portfolio manager at the firm, that you have this really positive long-term opportunity in fixed income, which we haven't had in well over a decade. So there are some brave souls, some dip buyers in the bond market out there. But at the same time, we're getting some pretty scary warnings about the corporate default rate. It's super low right now, but you have the likes of UBS, Barclays warning that a wave of defaults is coming.
Okay, can we talk about Fed Chair Jay Powell Mike McKee's question
Would you
about a
like
recession.
to?
I would like to. I mean, it was what I teased, and then you told me during the break it's not what you wanted to talk about.
Well, you know,
but
we've
I'm putting
talked
you on the
about
spot here.
that man a lot this week. Not Mike McKee, Jerome Powell specifically. But to rewind back to Wednesday and what Jerome Powell said, again, like Mike McKee told us, actually, I think it was yesterday, you're never going to hear the Fed forecast a recession. It's just not something that they would do. But Jerome Powell did say, no one knows whether this process, referring to, of course, their very aggressive rate hikes, whether that's going to lead to a recession, or if so, how significant the recession would be. And he paired that by saying the chances of a soft landing likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer.
So that R word.
Nonetheless, we're committed to getting inflation. So if you boil that all down, I think the message is pretty clear that they're going to sacrifice growth to get inflation, again, back down to 2%, which is pretty far away at this point. I love this comment from Seema Shah of Principal. She said that that's central bank speak for recession.
Okay, that's not a good thing, especially when we're seeing it play out around the globe and not just here in the U.S. Okay, what else? You want to talk inflation expectations?
We could talk inflation expectations. I got a little bit schooled by Jason Bloom. He's over at Invesco. I was having a casual chat with him. We were talking about break even.
As one does in a casual chat.
Of course, we're talking about break even inflation expectations. And he asked me, have you ever actually charted tips break evens versus actual inflation? And I had to say, no, I haven't done that actually, Jason. But the point being is, actually, it's a horrendous forecaster. Inflation expectations, if you compare it to CPI year over year, it's breaking apart. It's not a really clean correlation there. So that's interesting to think about when you think about how people will say that the Fed really cares about inflation expectations. The Fed themselves, the policymakers there, saying that they really care about inflation expectations, and they do, because that informs how people behave. That shapes reality that we live in. But again, if you actually look at inflation expectations versus the data, it's a pretty terrible forecaster.
Believe it or not, there are people out there who haven't signed up for the weekly fix.
Unbelievable.
How do they do it?
So this is embarrassing. I don't know how you do it online, but if you're a lucky person who has a Bloomberg terminal, you can go to the weekly fix and click subscribe on the upper left hand. That's how I would do it.
Okay.
Yeah. Are you subscribed? You better be.
Does it count as being subscribed when you forward it to me every Friday morning?
No, that is not a
That
subscription.
is not a
I
subscription?
need you to subscribe, and I need you to open it from your inbox specifically every single morning. And if you could click all of the links in it too, that would help me out. So
I'm guessing there's some sort of metric here that is important to
what
you.
gave it away?
Okay, hey, before we go, what
Yeah.
didn't make the newsletter that was interesting to you this week?
Oh my gosh, there was so much. I wanted to talk about the Citrix debt deal. How I feel like we haven't been watching one single issuer's debt drama like that for a long time. It just goes to show that it's getting harder to tap the primary markets right now. Everyone's nervous. Underwriters, too, are losing a lot of money.
That's Katie Greifeld. She is my colleague at Bloomberg Quick Take and also at Bloomberg Business Week Radio. She's anchoring this afternoon. Co-host of ETFIQ on Bloomberg TV as well, and a Bloomberg News senior markets reporter. Sign up for the weekly fix. Let's get to world and national news now with Nancy Lyons. Hey, Nance.
Thanks, Tim. House Republicans are promoting their agenda ahead of November's crucial midterm elections. They held a rally today in Pittsburgh to talk about the Commitment to America plan. House Minority Leader Kevin McCarthy says they're going in a new direction that's based on freedom.
Our job is to work for you, not go after you. Our job is to make America stronger.
McCarthy's four-point plan prioritizes illegal immigration, the opioid crisis, combating crime, and increasing fossil production. President Biden says he believes what's most telling about the GOP plan is what was not mentioned.
In the course of nearly an hour, here's a few of the things we didn't hear. We didn't hear him mention the right to choose. We didn't hear him mention Medicare. We didn't hear him mention Social Security.
Biden also accused many Republicans of hypocrisy for praising police while defending rioters who assaulted cops during last year's Capitol attack. British Prime Minister Liz Truss is shaking up the British economy by introducing the most sweeping tax cuts since 1972. Bloomberg's Lizzie Burden has more on the reaction.
Markets reckon it's going to add to inflation. That's why traders are now pricing for 100 basis points from the Bank of England in November. Secondly, it's clearly going to necessitate a lot of borrowing. The Institute for Fiscal Studies says while it's going to add to borrowing, it won't necessarily stimulate growth significantly.
Bloomberg's Lizzie Burden in London. The package was more ambitious than expected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenevec and Katie Greifeld. We're live in the Bloomberg Interactive Brokers Studio in New York. Katie, I got in my hand the new issue of Bloomberg Business Week. We talked about it yesterday. It's a great cover. A very happy Tim Cook is lying on a bed of what at first looks like snow, but you look closer. You look more closely, and it's revealed to be many, many individual AirPods.
It's a little unsettling.
Why is it unsettling? I think
don't
it's
know.
great.
They're a little
He's wearing
bit,
a parka.
Yeah.
Too. He's getting ready for
It's a
winter.
great cover. Don't
It
get
is a
me
great
wrong.
cover. If you open it up, inside there's more about not just that, but also about the Bloomberg Business Schools ranking that just came out, and some stories about the business schools. The person who heads up that entire thing, and we talked about this last week, but she said it is a huge team effort, is Dimitra Kesanides, and she's got a story on the terminal this afternoon about Columbia Business School reimagining its future with a new campus. It's based in Manhattanville, which is a few blocks north of the Ivy League institution's historic location. It's a glass building, or many glass buildings, I should say, and they offer a more open approach to business education.
The new buildings, they're called the Henry R. Kravis Hall and David Geffen Hall. They officially opened for faculty, employees, and students in January, of course, while the world was still grappling with COVID-19 lockdowns as Omicron spread. Now it looks like they're open to the public. They look pretty cool. We're both actually alums of Columbia, so I would like to see them.
Yeah, you were at the journalism school. I went to the business school.
You started in journalism, didn't you?
Yeah, I did a program that was in both schools.
Yeah.
But the business school, the business school that I went to, and that a lot of people went to, was not as nice as the new one, and it was like kind of dank. Uris Hall is what it's called.
I thought dank meant good.
I was thinking dark dank.
Oh,
yeah.
Okay.
Like kind of like
clammy?
basementy. Yeah, basementy. And it definitely needed an upgrade. And they were working on this years ago when I was there, so it's been a long time coming. Check out this story and much more coverage of the Bloomberg annual list of business schools at Bloomberg.com.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Well, the equity market in the States is clearly on the back foot today. Right now, the S&P down 2.7%, just off the session low. The low point of the day at 36.53 for the S&P. So we're clearly broken below that June 16th low that everyone was so concerned about at 36.67. Dow Industrial Average right now down about 2.5%, and the NASDAQ comp weaker by about 2.8%. So the sell-off in the risky corners of the market was, I think, triggered when the British government delivered the most sweeping tax cuts that we have seen from the British government since about 1972. And this comes at a time when the Bank of England is really struggling to rein in inflation. Inflation right now in the UK is running nearly 5 times the target for the BOE. Now, the Bank of England will meet next month, and the market is now talking about the possibility of a 100 basis point rate hike. I'm using the World Bond Market Index on the Bloomberg Terminal. Function is WBGO. If you look at the UK 10-year, we're up 33 basis points on the day to 3.82%. A US 10-year down in yield. A lot of conversation in the States that we're going to enter a recession as a result of Fed tightening. We knew or know now that the Fed's target for the Fed funds rate by the end of the year is 4.4%. That implies a move of maybe another 125 basis points in tightening. 2-year Treasury up 7 basis points in yield to 4.20%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Hey, thank you so much for that update, Doug Krisner. Really do appreciate it. Well, in the new issue of Bloomberg Business Week magazine, there's a story about social media companies. In fact, more than 70 lawsuits have been filed this year against such social media companies. We're talking about companies like Meta Platforms, the company formerly known as Facebook, Snap, TikTok, which is owned by ByteDance, and Google, which owns YouTube. The lawsuits center on claims from adolescents and young adults who say they've suffered anxiety, depression, eating disorders, and sleeplessness as a result of their addiction to social media. The story written by Joel Rosenblatt, legal reporter for Bloomberg News. Joel joining us this afternoon on the phone from San Francisco. Joel, good to have you with us. I got to tell you, reading this piece, the anecdotes at the top would make the stomach turn of really anyone about kids who have died by suicide, kids who are addicted to social media. I'm wondering, though, about liability here. Are social media companies reliable for what their users do?
Well, thanks for having me. That's what these suits are going to get at, and we're going to find out. The companies have, for a very long time, I mean decades now, stood behind Section 230 of the Communications Decency Act, which holds, that's a law that provides, that says that these companies can't be treated as the publisher or speaker of any information provided by or generated by a third party. So the argument being that these companies can't be held responsible for the content of what kids are seeing. So that's the big hurdle. They have a novel argument, these lawsuits do, that's a little bit different from anything that I've seen, and we can talk about that if you want. But that's the big question. That's the big hurdle of liability.
Yeah, talk about that a little bit.
Yeah, well, so what they're doing, what's different about one suit in particular that I write about, is that they're targeting the algorithms that these companies are using. And so instead of saying, oh, this content is what created the problem or created the depression or problems, it's the algorithms that you've designed, that you, Meta, have designed intentionally to hook my kids to your platform.
So it's not the other users who've posted this or interacting with people that way. It's the algorithm, what the algorithm is actually serving to these kids.
Exactly, and the claim is that it's designed intentionally that way, by those companies to keep them hooked and down this kind of spiral or these holes of information that take them to these dark places.
Okay, well, you make a parallel to cigarettes in here, and I want to bring in Katie Greifeld, my co-anchor here, because, and this is, I mean, in all seriousness, when she had COVID, she came back from COVID and said, you said, Katie, that you had fallen into this TikTok hole about and had talked about how well the algorithm got to know you and like served you content that you would just eat up.
It's actually a joke on TikTok when really specific videos go viral. All the comments are to the effect of the algorithm knows me too well. And people joke all the time that I'm so glad that social media wasn't around when I was younger. I have to say, I am so glad that TikTok was not around when I was younger. But Joel, I'm curious to hear about what some of the law professors that you spoke to for this piece are saying in terms of these social media companies' defenses.
Well, it's kind of a split. I mean, mostly you have law professors. Eric Goldman is one in particular who's really expert in this area at Santa Clara University, who points out that the Section 230 defense is just going to be too difficult to get over.
Explain what that is.
Because, yeah, well, Section 230 is the Communications Decency Act that we talked a little bit before, which they're just saying we're not responsible for the content. We can't be held liable for the content. We're just a delivery service. We're just giving you the platform, and we can't be held liable as the publisher or speaker of the content that you're seeing. So he's saying that that's, first of all, just a huge problem for these lawsuits. The second problem is that professors point out is that you can't just point to social media as the problem alone. In other words, isolating social media as the cause of depression, anxiety, or even suicide is just too difficult. Let's take any number of things, including, say, the fact that the planet is melting. There's all kinds of reasons that kids are suffering from anxiety, and to isolate social media is going to prove difficult, many think.
Well, let's go through some historical parallels here that you touch on in your piece, Joel. If we think about the way that auto manufacturers have been not necessarily held liable, but the public campaigns against them by Ralph Nader, for example, or perhaps the 1990s when it comes to tobacco companies. I mean, I recall those tobacco executives sitting there and testifying in front of Congress. How does that paint some sort of picture about what could happen with social media companies? Or does it? Is that accurate?
Well, I think, again, we kind of come up with we'll see what the courts decide, because there's at least two arguments. One is that, again, these suits are pointing to the algorithm as it's almost identifying it as a product. So pointing not to the effects so much, but as this particular product that they've designed that's, to follow the analogy, defective. So that's, that's the kind of logic there. On the other hand, if you say, let's follow the analogy of the tobacco suits, in the tobacco cases, I remember one particular part that was very compelling there was that the tobacco companies were adding ammonia to the tobacco. I don't know if you remember that. And you could point to them knowing that it caused cancer and knowing that this particular chemical reaction would cause addiction and cause cancer. I think a problem there for these lawsuits is that that's a particular health consequence. You could pinpoint cancer as a medical, scientifically a cancer, a disease that's caused by this product. Again, harder to do that with social media, if not impossible. We'll find out.
Are there, just in the last 40 seconds that we have with you, are there any proven health claims that can be tied to social media at this point, the same way that we can tie them to cigarettes?
Well, I'm glad that you raised that, because one of the suits that I'm following closely points to the testimony of Frances Haugen, who you may recall testified to Congress about Meta knowing that Instagram was causing all kinds of anxiety with girls in particular around their body image. And so, and they in her testimony was they knew it and perpetuated this and are still using it and profiting from it.
Joel Rosenblatt, legal reporter for Bloomberg News, joining us on the phone from San Francisco. Check out his story. It's in the current issue of Bloomberg Businessweek magazine. It's available now on newsstands and at Bloomberg.com.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. We are but 60 minutes left from your trading day, your trading week. Caroline Hyde, Romain Bostic, Taylor Riggs. We're joined now by Tim Stenovic, Katie Greifeld's in for Carol Massa, and together we go cross-platform to do day in, day out, TV, radio, YouTube, to dissect what is a very painful day across global equity markets, Tim.
Yeah, not just happening in the U.S., happening worldwide, but here in the U.S., the S&P 500 at levels right now that if it were to close where it is, it would be closing at 22 lows. I am, though, looking for some areas of outperformance, and to do that, we look at the home builders today, which are actually lower, but not by as much as the S&P 500 right now. Home building stocks outperforming. We're seeing yields on the long end have come off of earlier highs, so we're seeing a little bit of outperformance in home builders today.
A little bit. I do want to talk about some more bonds, though, specifically investment-grade bonds. Let's look at LQD. This is a investment-grade corporate bond ETF. It's down 0.5% right now. It actually hit its lowest level since 2010 earlier today. Really just shows you the widespread nature of this sell-off right now.
And we were just talking about the repercussions that has for primary issuance coming next week, what that means for the credit markets, how open they are. At the moment, the equity market is off and we're at 3,652. More than 100 points for Taylor Riggs down on the S&P 500 for percentage point. That is therefore 2.75% on the lower side. We know, of course, that is below the previous intraday low that we got back on June the 16th. I mean, on the previous closing low that we got on June the 16th. I'm looking at what's happening in Dow Jones. We're off by 2.6%. The NASDAQ feels the pain, off by 2.8%. And small caps really under pressure, off by almost 4% on the Russell 2000.
And for the week, 7.5%. Some of the biggest weeks that we haven't seen since December of about 2021. So you're really sort of getting some weakening here. Take a look at where we are on a sector level. Everything in the red. Energy remained, of course, off some of the most, off 7.5% on the day, as we've seen crude go below 80 a barrel for some of the first times that we haven't seen in quite some months, since really earlier this year as well. Healthcare, real estate, the mild outperformers, but you're still off about 2%. Even within those, only 3% of those stocks are in the green. So even within those sectors, it's nothing.
Yeah, you got 493 stocks right now down in the S&P 500. We talk about a 90% decline, meaning more than 90% of the members in the S&P are lower. That's happened so far, including today, 17 times this year. You look back in past years, you know how many times that happened? Maybe once or twice per year. Apple down 2.5% here on the day, down on the week. American Airlines down 6% on the day, setting up for what's going to be its steepest weekly decline going back to March. And then take a look at two names, Tellurian and Marathon Digital. We don't talk about these two companies a lot, but we talk about sort of the risk out there for a lot of companies, the credit risk, higher rates, the ability to borrow. Tellurian, of course, couldn't come to market with that junk bond deal. We're now learning that the company has actually lost a couple of key contracts that it had. Those shares down about 15%, of course, after just tumbling 50% earlier in the week. And Marathon Digital down about 11%, 10% right now. This after a company that actually supplies it with data center operations actually went bankrupt or filed for bankruptcy in Texas, a company called Compute North Holdings. And now there's a lot of concern about the reverberations. We talk about systemic risk, whether it's there, but we do know there are second order effects. So some obscure private company files for bankruptcy, a publicly traded company is affected by it.
Let's talk about global reverberations today, Romain, because I want to highlight what's happening with the Great British Pound, and it is at new intraday lows at the moment. We are currently having its worst day for the pound since March 18th, 2020. We're off by 3.64% now. This is the lowest since 1985. I think this was the other downdraft in terms of mood music, in terms of risk tolerance, was because we saw the UK just go completely alone in terms of its fiscal focus versus its monetary policy focus. And we have an inflationary policy that therefore is worrying bond markets. A 50 basis point move in 5 years.
Was everybody like just completely baffled by that? I'm not talking about the market moves, but I'm talking about the decision to actually put this tax cut out there at a time when I guess everybody I thought was trying to fight inflation. But maybe I'm wrong. Who knows? And I'm not an expert.
The British public knew it was coming on this mini budget, but it was an explosive level of tax cuts that mainly seemed to be helping the wealthy, and the market was just merciless in terms of its ramifications.
I love the Tories. They really have great timing.
It's just incredible to see the weakness in the pound. And I mean, I remember when it was like $2 for 1 pound.
Look at this. Look at this. I got a pound right here.
Yeah.
This is it. Well, I don't even know what this is worth. Is this a 10?
£10?
The Queen's still on it here.
That's roughly.
Dude, you can't rip it.
Romaine, I
Rip
think
it.
Rip it.
Romaine, you're gonna rip
Anyway,
the
if
Queen
anybody wants a
on
pound,
there.
I'll give me a quarter. I'll give you the 10.
I'll see you.
I'll take it because I'm going to the UK relatively often at the moment, and it's still good currency over there, just not here.
Well, look at the way it's just rippling through markets today. Hey, I want to talk a little bit about a reset because we've been talking about the resetting of expectations based on what we heard from the Fed earlier this week. Well, Lisa Abramowitz posed that question this morning to Evercore ISI Chief Equity and Quantitative Strategist Julian Emanuel. Here's what he had to say.
We're calling for earnings next year basically to be flat year on year. We slashed our price target, and it's one of these years that now actually Wednesday has ushered in the emotional phase of this bear market, simply because when you look at what the Fed chair said and the projections, and importantly, it's that unemployment number projected to be 4.4% next year, where the rate of change, there's never not been a recession following hard upon that kind of change.
That was Julian Emanuel, Evercore ISI Chief Equity and Quantitative Strategist, earlier on Bloomberg Television. Well, if Wednesday was the emotional beginning of the bear market, what do we have today when we're seeing lows that we haven't seen at all this year, Katie?
Looks like a lot more emotion. I do love that phrase. I want to steal it. We were talking, though, to Abigail Doolittle earlier today. She said the charts have been ugly for a while. It does feel, though, that just the unsettled nature, the panic maybe has turned up a little bit. I think emotion is a great way to describe it.
Is it panic, though?
It's hard to say panic when the VIX is not quite cooperating, but again, you just look at...
The VIX never cooperates.
It never cooperates, but I don't know. It still feels out of sync below 30
Have you written a story today yet, Katie?
Love this.
I mean, this is like the time where I look
morning?
out for a Katie Greifeld, Vildana special here to kind of explain what's going on in the market, and yet here she is on radio.
I know, unbelievable. We did have a heavy hitter yesterday, though, where we made the point through a group of strategists, of course, that why would you buy right now if the price is just going to go down? I mean, again, the message from Jerome Powell on Wednesday was pretty clear. There is pain to come. It just feels like it took a while for that message to hit. He had to say it a few times.
And I think it was sort of the hawkishness of 75 in November, 50 in December, and then according to Goldman, at least another 25 in February, and sort of the re-rating that comes from that. All of the math then says that a PE ratio, a price index remain, it has to go lower. So what was more about a revaluation as well, about what November and December bring?
But how much of this also was not just about the Fed, but the other central banks as well? The idea that now this really is sort of a global tightening that we really haven't seen, at least in a couple of generations.
And I think it was historic just from getting out of, I'll say it again, NERP and ZERP. We're finally, minus the BOJ, for the first time in decades, out of zero interest rate policy.
Romain's going to stop.
I've been trying to, so I've realized you can rip it, but you have to move over to the side.
Cash isn't trash right now. I know maybe the British pound is, but everywhere you should.
Are they going to put King Charles on this thing or not?
Eventually,
Isn't that the plan?
I don't know. I don't know how that works.
in the handover
And
of
they just forget about Queen Elizabeth?
No, she just continues in circulation until people like you rip up and they become we can't use them as tender.
Better hold on to that pound, Romaine.
Yeah.
We really went everywhere.
We're going
this
digital.
afternoon.
We did. That's it. We cover everything here. It's a
We
wild
do.
day, Tim.
And we're going to be
Try
back with
keep
you
up.
guys in less than an hour, live on TV, radio, and YouTube, 4 p.m. for our Beyond the Bell coverage when we take you through today's market close.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld in this afternoon for Carol Masser. Worth taking one more look at the markets. The S&P 500 right now trading at 3673, down more than 2.2%. So we are off of those lows, but still just a brutal day here. The Dow down 2.1%, the NASDAQ down 2.3%. Katie, this puts us right now at a 5-day loss for the NASDAQ at 5.6%, the S&P 500 at 5.1%, and the Dow at 4.4%.
It is just, I mean, I'm a little startled by these moves. We'll see what the last half hour or so of trading brings. Classically, that's been a very volatile time. And it looks like if you look at least some of the markets, I'm looking at LQD still pairing a little bit of the losses, but still pretty negative on the day.
All right, we're going to continue to cover the markets and, of course, deep dives into some of the big companies, including this afternoon. We're going to go crypto, and we're going to talk steel and other natural resources as well. First up, though, let's get a check of world and national news. For that, we go to Nancy Lyons. Hey, Nance.
Thanks, Tim. Russia has begun staging votes on annexing the parts of Ukraine that it still controls. The UN has condemned the votes, calling them, quote, a violation of the UN Charter and international law. Ukraine and its allies have denounced the referendums as illegal, and few countries are likely to recognize the results. Well, House Minority Leader Kevin McCarthy has been in Pittsburgh today, focusing on elections here just weeks away. He's promoting a GOP plan that will be implemented if they take back the House.
The commitment to America, ours is to make an economy that's strong, to tackle the cost of living and what is happening in our economy.
McCarthy says the Republican plan would combat illegal immigration, give parents a greater say in their child's education, and rein in government. President Biden took his midterm message to a group of supporters at a Democratic National Committee event today in Washington.
46 days to the midterms. We need to be crystal clear about what's on the ballot, because there's a heck of a lot at stake that's on the ballot. Right now on the ballot for Social Security. It's on the ballot.
Biden says 158 House Republicans have signed on to a Republican budget that would cut Social Security and Medicare. Get ready to pay more for your Thanksgiving dinner this year. Turkeys are at a record high, mostly due to an unexpected resurgence of bird flu sweeping across the country that's forced millions of hens and turkeys to be culled in recent weeks. As a result, prices are nearly 30% higher than a year ago, 80% above pre-pandemic costs. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons. Really do appreciate it. On the Bloomberg Terminal this afternoon, we've got a story by Don Lim, and it's among the most read. It's about private equity valuations, those write-downs, spurring mounting scrutiny from the SEC. So buyout firms have been forced to erase billions of dollars from the value of their wagers in the economic downturn, and financial regulators are now scrutinizing whether managers are reducing fees for investors when those deals sour.
So these questions, they come up sporadically throughout the years, but regulators are now asking private equity firms about the issue regularly in routine exams and seeking a level of detail that they didn't before, according to people familiar with the matter. And the goal is to make sure that private equity firms, which of course take a cut of the money they manage, aren't overcharging state pensions, university endowments, and other investors, Tim.
Yeah, SEC officials are ramping up those inquiries. What they're trying to do is to root out what they consider a chronic practice of firms charging more than contractually allowed, and because regulators recognize that firms face pressures to juice fees in the market downturn.
And a spokesperson for the SEC did decline to comment, we should say that. But the SEC under Chair Gary Gensler is making more aggressive pushes to police private equity firms. This industry, of course, has grown rapidly over the past decade to become a bigger part of both the finance industry and the U.S. economy. So far, it's avoided the same level of regulatory oversight that banks and mutual funds are subject to. We'll watch this space.
Well, let's talk about these fee arrangements, because the fees often or I think it's fair to say in some cases, are a little confusing. Private equity firms tend to have complex fee arrangements. Most funds shift from charging fees on money pledged by investors to taking a cut of invested funds after a few years. When that happens, fund managers typically can't charge fees on investments written off to zero or deemed permanently impaired. So in rare cases, fees are supposed to be reduced following write-downs.
And of course, this follows big market declines and post-pandemic shifts in how people live and work, and that's hurting valuations of once high-flying tech shares.
Check out this story and more from our private equity team, including Don Lim. You can do that at the Bloomberg Terminal and at Bloomberg.com.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
What a way to end a turbulent week. We have the equity market here selling off after European equities did pretty much the same thing. Let's get the very latest on today's price action. Bill Maloney is at the Bloomberg Macro Squawk Desk. Hey, Bill.
And good afternoon, Doug. U.S. stocks plunging from the start today, with the Dow currently down 605 points, and that's off the lows of 826. S&P's drop 82. NASDAQ is lower by 2.3%. The U.S. 10-year yield at 3.69%. Gold slumps 28 points. Energy is sinking, and Bitcoin is down by 3%. Among the main 11 S&P sectors, leaders to the downside: energy, consumer discretionary, and materials. And in the Dow, only J&J and Home Depot are in the green, while Chevron and Boeing each fell 6% and led to the downside. After earnings, Costco fell 4.5%. And in other news, private equity write-downs spur mounting scrutiny from the SEC. Wrapping things up, the U.S. 2-year yield rose for a 12th day, hitting 4.27%. Live from the First Breaking News Desk, I'm Bill Maloney. Doug.
All right, Bill, thanks. Well, in the bigger picture today, the British government delivered the most sweeping tax cut since 1972 at a time when the Bank of England is already fighting inflation. Now their speculation is the BOE will have no choice but to raise rates next month by 100 basis points. From here, given tightening that we're expecting from the BOE and the Fed, it's a very short walk to the notion of global recession. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right. Thank you so much, Doug Krisner. Let's turn to crypto now and welcome in Danelle Dixon. She is CEO and Executive Director of the Stellar Development Foundation. It's a nonprofit organization founded in 2014 to support the development and growth of the open source Stellar network. She joins us on the phone from San Francisco. Danelle, great to have you with us. Just about a week ago, you testified in front of the Senate Agriculture Committee. That hearing specifically was focused on the Digital Commodities Consumer Protection Act. That, of course, is a bill focused on the CFTC's role in regulating the crypto markets. I feel like that's a big question. Which of the acronyms actually has oversight over the crypto market?
Yeah, thank you so much for having me again. Yeah, that is a big question, but I think that what we're going to find is that both of them, and I think you're referring to the SEC and the CFTC, are going to have a role. And I think what we talked about last week with respect to this legislation was that it is really wonderful and empowers the CFTC with the authority that it needs to regulate the spot market for digital commodities. And it provides a lot more clarity to the industry than we previously had. So it's bipartisan, which we love to see. And it's continued reinforcement that crypto is not an issue that's divided by politics, and that everyone is invested in it, and they have to get this right. So I think we're going to see a lot more clarity if we see bills like this one come through the House and the Senate.
What are the stakes here?
The stakes are pretty high in terms of really what we want to see is a lot more players in the existing financial infrastructure come into the crypto and blockchain space, because it really, like what we focused on is payments and cross-border remittances. We need to see stable coins. We think we need to see other players that are involved in those kinds of payments participate in this. And I think that it not only gives clarity to the existing ecosystem, but it gives a lot more clarity to others who might want to participate, but they're concerned because of the regulatory environment.
How, I'm trying to think of the word that I want to use, but I mean, how receptive are the lawmakers, specifically at last week's hearing, and other lawmakers that you speak with about the crypto industry? I feel like it's had some real black eyes, especially over the past few months, a lot of high-profile blow-ups. Do you think that's sowed a bit of skepticism or mistrust along some of the potential regulators?
Well, I think it's a great point to focus on, because I think that any industry that's new, you're going to have like 30 steps forward and then 20 steps back, and you're going to have to climb your way back to the spot that you were before. And I think what we saw over in the early days of the summer with respect to those algorithmic stablecoins and what happened with respect to the market there will really actually change a lot if we can get the focus to create stablecoin legislation that makes it clear about a definition of what stablecoins are, because that's a lot of what we saw. There was a lot of leverage in the market. It had little to do with the infrastructure and more to do with just leverage. So if we see clarity around this, I think that we're going to see more and more lawmakers want to participate here. Right now, and particularly last week, there's so much support within the Senate Ag Committee because they are truly a bipartisan committee that works together. So we saw a lot of really good conversation and a lot of really good inclusion about this particular, the bill itself, but also just the industry. And frankly, I think we're seeing that across the board, even on the House side. So I feel really good, and I think the promise of not just this legislation, but we hear that there's also potentially stablecoin legislation that could be brought together, and I think that could come together also in a bipartisan fashion. So it'll really move the industry forward and create, again, that regulatory clarity. We all need it. One of the things that we hear a lot from the SEC is that the Howey test, which is the one that defines what a security is clear. And frankly, if it was clear, we wouldn't be in the situation right now of trying to gain more clarity. So I think that we all really want to see that happen.
Hey, Danelle, we heard the big bank CEOs testify earlier this week, and one part that stuck out to me was what Jamie Dimon, CEO of JP Morgan Chase, said. He called digital tokens decentralized Ponzi scheme, and even Bitcoin specifically. He had some choice words for it. It kind of sticks with what he said in the past. I'm wondering what you thought of when you heard him say that.
Well, it wasn't new in terms of, again, like as you said, we've heard this in the past. And I think part of the job that we have as industry is to really create a lot of educational materials and to really gain the focus and the attention of folks around the good things that are happening with respect to blockchain and crypto. You know, on Stellar, we see a lot of really big promise and execution. When we see the use of stablecoins in payments, we have a relationship with MoneyGram where you can turn cash into crypto in 420,000 locations globally, and this really reaches the unbanked and the underbanked. And so I think if we really talk about what the good things that are happening in the crypto and blockchain industry, it actually will help move that conversation away to talking about things like Ponzi schemes, because I think that, you know, any time when you have a new piece of technology, there's going to be a lot of criticism and potential concern of it. And we really need to get to the discussion around use cases, which will kind of obliterate that message.
And Danelle, really quickly, we have about 30 seconds or so, but you've said clarity a few times, and we need clarity. Who needs clarity? Is it just the industry, or is it traditional finance, TradFi as well?
Yeah, no, I love that, TradFi. That's another word that we like to hear. I think it's everybody. We all need clarity to bring TradFi in so that we can actually really make this technology work in the way that it should, which is in coordination with traditional finance to really bring to the masses the opportunity that exists with blockchain.
All right, Danelle, we're going to have to leave it there. Danelle Dixon, CEO and Executive Director of the Stellar Development Foundation, joining us this afternoon on the phone from the Bay Area. Quick check of crypto this afternoon. We're seeing Bitcoin down by only 3%, $18,678. Ethereum, Ether down 3.2%. You're listening to Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenivek and Katie Greifeld in this afternoon for Carol Masser. In just a few minutes, we're going to be speaking with Shaheen Contractor. She's environmental, social, and governance analyst for Bloomberg Intelligence. She's going to talk a little bit about how different companies are looking to meet their carbon goals and talk a little bit about the steel industry. So we're looking forward to that in just a few minutes. First up, though, let's get over to Doug Krisner for a market update.
When stocks hit your eye like a big pizza pie, we are down quite a bit today. But good news is we are off session lows. The S&P 500 at its weak point of the day was down nearly 3%. Right now the loss is only 2%. Energy leading the slump here with the energy group down about 7%. This is tracking a lot of weakness in the crude oil market. WTI now in the extended session off by more than 5.5%. We're trading about 78.85 at the moment. So the equity market stateside joined a sell-off in European equities, and this was triggered by the British government delivering its most sweeping tax cuts since 1972. For markets, you got to be concerned that these cuts are going to fuel inflation. We know the Bank of England is already struggling to rein in prices, and now the speculation is that the BOE is going to have no choice but to raise rates by 100 basis points next month. Earlier this week, remember, the Fed's forecast for its Fed funds rate, that's the key policy rate, it should be, according to the Fed, at about 4.4% by the end of the year. So the math indicates another 125 basis points in Fed tightening. Today we have a two-year Treasury yielding just under 4.20%, and a lot of conversation around global recession. Dow Industrial Average off about 1.8%, NASDAQ comp down 2% today, but look at the dollar on a rally today with the Bloomberg Dollar Spot Index up about 1.3%. The euro is tumbling, and we've got a weaker yen as well. I'm Doug Krisner. That's your Bloomberg Business Flash.
Hey, thanks so much, Doug. Really appreciate it. Well, I did say earlier in the program we'd spend a good portion of the show this afternoon talking metals, mining, and we're not just talking crypto here. We're also talking natural resource, including steel. For that, we have Shaheen Contractor. She's ESG analyst for Bloomberg Intelligence. She's with us right now in the Bloomberg Interactive Brokers studio. Shaheen, when we think of steel companies, or kind of anything when it comes to heavy industry, natural resources, removing things from the ground and then melting them at high temperatures in order to make things, we don't necessarily think ESG. Why should we be looking at these companies?
Thanks, Tim. So Tim, if you think of something like steel, which is highly resource intensive, I think actually that's one of the main sectors where you would think ESG, right? I mean, those are the ones that probably emit the highest emissions. I mean, steel is one of the most carbon intensive sectors. So in an environment where you have regulation like Europe, the cost could be pretty high. We estimate it to be about 9.5% of EBITDA, actually. So it almost seems like a natural fit to me, actually.
That ESG and sort of these very intense use of materials. God, it is
yes,
very
it's
much
natural resources.
That makes
you
a
can
lot
do
of
this,
sense.
Katie.
I'm powering through. So let's talk about carbon goals, because in your research you lay out that steel companies in particular they've strengthened carbon goals. Where are they actually on the path to meet those?
So, Katie, most steel companies actually fall short of anywhere close to this 1.5 theoretical degree scenario that the world should meet by 2030. So there are actually only 3 out of 17 companies that we calculate to meet these reduction goals. Mm-hmm. And it's clear that the steel industry as a whole is further behind. And it's a very, very hard to abate industry at the end of the day.
Who are those 3 companies? Who's doing it?
So it's SSAB, it's Steel Dynamics, and it's Nucor. Those are the 3 steel companies.
What are they doing specifically in order to decrease their reliance on fossil fuels? I mean, earlier this week, we had Fortescue's executive chairman, Andrew Forrest, on the program. He joined us from the Earthshot Prize Summit here at the Plaza Hotel in New York. And it was pretty cool. He talked about putting $6 billion, Shaheen, toward decarbonizing the entire iron ore mining process at his facilities. That's a tall task, and we're talking billions of dollars here.
Yeah. I have to say I was very impressed by that. I remember Fortest to be leading on our mining sector scores. They're the only company to have these 2030 carbon neutral goals. So I thought I'd just mention that.
Wow.
Yes, but for SSAB in particular and steel.
I'm going to send you the interview if you haven't heard
Yeah,
it.
please.
It was fun. It was a good one.
Good, I'd love to. So SSAB in particular, they again, like for Fortest, they're the only ones to have this 2030 carbon neutral goal, almost carbon neutral, and they're investing heavily in hydrogen. So they aim to be fossil-free. They aim to produce fossil-free steel by 2026, which is an investment in hydrogen. And for others, it really differs.
Are there any penalties for these companies if they don't meet these targets?
So in an environment where you have carbon costs like Europe, theoretically those go up. That's the penalty. It's the carbon regulation coming in.
Okay.
So where do investors need to be looking for opportunities right now when it comes to what you're writing about and thinking about with ESG and with natural resource companies?
Sure. So when it comes to, again, these carbon goals, I think it's companies that are best positioned for the transition, which means that they're at this sweet spot where they are sort of investing enough to avoid these carbon costs, if that makes sense. Because, again, for SSAB, our analysis suggests that this investment is positive, but only in a high steel price environment, because if steel prices fall, that's going to be a problem. And if carbon costs stay high, so that you avoid that cost by making these investments. So it really depends.
So 3 out of 17 companies in the steel industry sort of meeting these guidelines. It doesn't sound great, I have to say. Broaden it out for us. What do other industries look like?
So mining, for example, it's much more. I feel like it's about 28% of companies meeting these reduction goals. For oil and gas, it's again more than steel. For other really hard to abate industries like cement, it's similar. It's 3 out of probably 16 companies in cement that we analyze. For airlines, it's again quite ambitious. It's a lot of airlines meeting these goals. So it differs per sector.
How do airlines meet the goals?
I'm not too sure. I don't cover that industry, but I'll come back to you with that.
Okay, cool. Hey, before we let you go, Shaheen, when it comes to this group of companies that you cover, are you more focused on the E, the S, or the G?
So for steel, it again depends on materiality, and I have to say the E because it's just so carbon intensive.
It's so energy intensive, yeah. I wonder if we'll get to a place where we'll actually see a significant change in how these companies are harnessing carbon in order to make this stuff, because we all rely on it.
I think we're getting there.
Okay, I like ending on that optimistic note.
Yeah.
I like that. Shaheen Contractor, Environmental, Social, and Governance Analyst for Bloomberg Intelligence, with us right now in the Bloomberg Interactive Brokers Studio. Worth looking at the markets one more time right now. The S&P 500 down a little over 2%, so we're off of those lows. 3682 is where we are. The Dow down 1.9%. The NASDAQ down 2%. Let's get over to World and National News with Nancy Lyons in Washington, D.C. Hey, Nance.
Thanks, Tim. Well, with the congressional elections looming, President Biden is in campaign mode, speaking off the cuff with a handheld microphone at a rally sponsored by the Democratic National Committee. We get more from Bloomberg's Irv Chapman.
The president said a Democratic Congress would legislate the right to abortion. A Republican Congress would restrict it, and he'd veto their bill.
Social Security, it's on the ballot. Gun safety for our kids and gun violence on the ballot. The survival of our land is on the ballot. It genuinely is.
The president said the principles headlined in a new Republican manifesto sound good, but they voted against every measure he proposed in furtherance of those principles. In Washington, Irv Chapman, Bloomberg Radio.
Voting is already underway in Russian-held regions of Ukraine on referendums to become part of Russia. But Bloomberg government's Emily Wilkins says Ukraine and the West call these sham elections.
They see this as an escalation of Russia's plans to annex swaths of Ukraine. This is really reminiscent of a similar 2014 ballot in Crimea that led to Russia attempting to annex the territory.
Bloomberg government's Emily Wilkins. In Moscow, officials are vowing to move quickly to finalize the absorption of the territories. Roger Federer is bidding farewell to his tennis career with one last contest before he heads into retirement at the age of 41. Today, he is playing in a doubles match with rival Rafael Nadal for Team Europe in the Laver Cup against Francis Tiafoe and Jack Sock of Team World in London. This marks the end of an illustrious career for Federer that included 20 Grand Slam titles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons. Really appreciate it. Well, let's talk a little bit about real estate. We got a great story on the Bloomberg Terminal by Jennifer Epstein, all about Citadel's Miami move and what it's doing to a hot U.S. market. Ken Griffin's plan to move Citadel's headquarters to Miami has hundreds of its employees ready to dive into the real estate market. From Chicago to Miami.
From Chicago to Miami. It's going to add news buyers, of course, to the mix in the Florida city, while also tweaking who's looking around in the previous hometown of Chicago. At the same time, Citadel is planning to expand its presence at some Park Avenue offices in New York. Of course, that's a city where Ken Griffin spent $238 million in 2019 for the top floor fours of 220 Central Park South.
That's not very far from here.
No, it's right over there.
It's an easy commute if he wants to come over to the Bloomberg headquarters.
I'm sure we would love to have him.
We would love to. He's been here before. We would love to have him back. Citadel's employees hunt for their new spots. The boss has already been plotting out his own real estate empire in Florida. Griffin has spent $194 million buying adjacent properties on Star Island. That's between Brickell and South Beach. And earlier this month, spent $107 million on a waterfront estate. That's in Coconut Grove.
Coconut Grove. Gosh, I love the names. Should
we go through some of this list of places?
Yeah, there's a cute guide to what's possible with a more modest budget of just $2 million. You could buy in Coconut Grove. It's surrounded by lush tropical greenery. There's a house with a Mediterranean exterior. It feels farther away from Brickell than the nearly 15-minute drive would suggest. Sounds nice.
Okay, well, maybe if downtown Miami is more your speed, you got a place for $1.84 million. It's a condo on the 45th floor of the Elzer Hotel and Residences. You've got unobstructed views of Biscayne Bay, the Atlantic Ocean, and the downtown Miami skyline. And then you could also get a 1.5 bathroom apartment, with concrete floors and ceilings for $1.9 million here in New York City.
Good.
Check out this story and more on the Bloomberg Terminal and at Bloomberg.com. It's Bloomberg Business Week.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
On our way to the closing bell to finish a very turbulent week for the equity market, and today was pretty dramatic. We had a sell-off, U.S. stocks collapsing after European equities sold off when the British government delivered the most sweeping tax cuts since about 1972. If you're in the market, you got to be concerned that these cuts will in turn fuel inflation. We already know that the BOE is struggling. The Bank of England has been struggling to rein in prices, and now the talk on the street is that the BOE is going to have to hike rates next month by 100 basis points. Earlier in the week here in the States, the Fed was forecasting a move up in its key policy rate to 4.4% by the end of the year. So we're looking, if that stands, we're looking at another 125 basis points in Fed tightening. Today, the two-year Treasury was up in yield by more than 6 basis points to 4.18. Now, the equity market is down, yes. S&P 500 off about 1.7% right now, but we had been down nearly 3% earlier. So we're finishing, if we hold at these levels, well off the worst level of the day. Dow today down 1.7%, or at least at the moment, that's the loss. NASDAQ comp weaker by about 1.8%. The beneficiary, though, of this move up in rates, the dollar. We have the Bloomberg Dollar Spot Index rising 1.3%. That gives us a much weaker euro, 96.91 U.S. cents, and the yen weaker as well at 143.28. I'm Doug Krisner. That's your Bloomberg Business Flash.
Thank you so much for that update, Doug Krisner. It is 3:49 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. The campaign by several Republican governors to transport asylum seekers to Democratic-controlled areas such as Washington, D.C. has been a national embarrassment. Whatever point Republicans may have had about migration, they have forfeited their moral authority by treating vulnerable people as props. But while President Biden has rightly denounced the relocation stunts, his administration and the Democratic-controlled Congress should do more to fix the underlying problem. They can start by boosting support for the Federal Emergency Management Agency's Migrant Assistance Program and fixing the nation's perennially underfunded immigration courts. Biden might not want to call attention to the issue in an election year, but it's his responsibility to work to fix it. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, it's that time. We are less than 10 minutes away from the close of equity trading here on this Friday afternoon. What a day it's been. What a week it has been. The S&P 500 off of its lows, but still down about 2%. In the S&P 500, energy, by far the worst performing sector, down close to 7%. This after we saw that WTI fell below $80 for the first time since January. Let's get into it, and specifically energy. We do that with Ben Cook, portfolio manager at Hennessy Midstream and Energy Transition Funds. Ben joining us on the phone from Dallas, Texas this afternoon. Ben, how are you?
I'm doing well, thanks. How are you? Thanks for having me, by the way.
Yeah, we're really glad to have you, especially on a day like today, because we definitely want to talk energy. What's going on in the energy market? I mean, is this just flashing recession fear all over?
You know, I think it is. I think, the prospect of monetary tightening around the world is leading to a view that we're going to have to see some slowdown in economic activity or worse, a recession. And I think that's added to fears with China's zero COVID lockdown policy, which has had a material impact on transportation fuel demand in that region of the world. I mean, I think that's all contributing to a narrative that the market may not be as tight as previously thought, but that's leading to fears of further weakness in crude.
And where does that leave you in terms of conviction here? I mean, would you expect a rebound, or how long might this current slump in energy last?
You know, that's a great question. You know, we do have a favorable view of the commodity as we approach the fourth quarter and into next year. And I think the demand fears are front and center, and that's what we're dealing with today. But there are significant issues on the supply side as well that, in our view, will continue to provide some support to the commodity. And you know, those points are severalfold. I think, look, you could, if you look at inventories, not just crude oil, but refined products on a global basis, we're below historical seasonal norms. OPEC is continuing to underproduce its targeted quota levels. And of course, we're seeing good financial discipline here in the United States by our producers, and that's limiting production growth here. On a near-term basis, we'll have the SPR draws come to a close in November. And of course, we've got embargoes on Russian oil exports into the EU in December and refined product embargoes in February. So on a short-term basis, there's some supply support to be had, I think, on a near-term basis.
Hey, Ben, did the SPR, did tapping the SPR, as President Biden chose to do, did that have an effect on the energy market?
You know, I think it did. I mean, on a month-to-month basis, actually on a week-to-week basis, you know, we were seeing the addition of, you know, upwards of 5 to 6 million barrels and even more some weeks added to the supply here in the U.S., and that certainly put pressure on crude prices. I think once those draws come to a close, once we eliminate that additional incremental barrel from the market, it certainly will add to some support to pricing.
And Ben, when I look over the course of this year at a sector level, energy, by far the energy sector is the winner, still up about 28% for the year. But I remember when that number was closer to 40% year to date. And I would love to hear your perspective on, you know, if you look at energy stocks, specifically the sector, have we seen the high watermark?
You know, for the year, I think going into the fourth quarter will probably be quite volatile as we enter the winter heating demand period. We could see some volatility in commodities, which would lead to a volatility in equity values. It's hard to see the commodity retracing back to the previous peak of $100 plus over the next couple of months, given the headwinds we're seeing today. But as I said, you know, there's good reason to believe that support on the supply side for crude and for natural gas, for that matter, which we have a very favorable view on natural gas pricing into next year, that will add some buoyancy and support into pricing. So while we might not retrace back to previous highs, we do feel like there's good reason to believe that there's good outperformance relative to other sectors in the marketplace to come here over the next 12 to 15 months.
So Ben, what are you doing on a day like today? Are you sitting on your hands, or are you buying?
You know,
or selling?
We're always monitoring commodity price volatility and its impact on equity values. As a part of our repeatable investment process in managing the Hennessy Energy Transition Fund, we look at what range of commodity price scenarios and what it might mean for the relative upside and downside in equity values. And for us, when we look at equity values, particularly, you know, we're taking the upstream sector in the U.S., we see an imputed price deck of roughly $65 to $70 per barrel implied by the current equity values across much of the upstream sector. So with the, you know, commodity on a 2023 basis, the strip there roughly in the $75 to $76 range, we think the equity values are right now, or even though they're down 5, 6, 7%, they're pricing in a much dire scenario than what's currently reflected in the commodity market. So again, valuation on that basis is attractive. We look at the free cash yields have been very, very strong in the sector, even with a dial down in commodity prices as we've seen over the recent weeks. We still see very attractive free cash yield out of the sector. So on a day like today, we're monitoring the portfolio, but we still believe very strongly in the outlook for the commodity and the financial returns and performance in the stocks.
I should note that the Hennessy Midstream Fund has a year-to-date performance of 22% compared with the S&P 500, which is down about 22%.
Yeah, energy, it's been a pretty good place to hang out. Ben, we only have about 40 seconds left with you, but I know you have some specific names that you're pretty bullish on. What are they?
Yeah, as I mentioned, we like the upstream sector here in the U.S., select integrated companies. We do like Exxon. We think their integrated business model affords flexibility to benefit from a variety of cyclical environments. They've shown some good strength in upstream results, exploration in Guyana, and development activity in West Texas. We think they're going to continue to generate very strong financial results and continue to buy back shares. We like Exxon. EOG Resources, another name that we like, the U.S. producer. They've got great acreage in the U.S. lower 48 shale plays and demonstrated an acumen for optimizing production gains and efficiencies, and that's translated to good shareholder return and so forth.
Ben, we unfortunately have to leave it there. Ben, we love having you on the program. Please do come back soon. Ben Cook, Portfolio Manager at Hennessy Midstream and Energy Transition Funds, joining us from Dallas, Texas. Coming up now, it's Beyond the Bell with our friends at Bloomberg TV.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast on this Friday afternoon with Tim Stenovic and Katie Greifeld. We welcome our audiences across Bloomberg Television, Bloomberg Radio, and on YouTube. A day here, Tim. You go back a couple of weeks ago. I mean, we were above 4,000 on the S&P 500. Right now, we're trading below 3,700.
Yeah, the question was for the last couple of months if we would retest those lows that we hit back in the middle of June. We did today, and then some, with the S&P 500 falling below 3,666. Katie.
It was a test. It looks like ultimately it won't be a break. I don't know. There's about 70 seconds to go. It is interesting to note that this came on a huge surge in volume. The S&P 500, 31% above, I think it's 20-day average. So a lot of conviction selling out there.
And I do wonder, and it'll take maybe another week for us to finish this debate, if this sort of qualifies as a retesting of June lows. I know a lot of market participants had been looking for another sort of big washout day, Caroline, to signal all clear ahead, or does this not count? And we're really looking at still a hawkish Federal Reserve who's looking at, as Goldman Sachs saying, another 75, then another 50, then another 25. And does that need to get behind us before you have an equity market that can settle out?
And a Fed tightening program that perhaps doesn't even work in terms of maybe looking at a labor shortage that is so severe that none of this can really dial back the anxiety when it comes to price pressure. That's the view of KKR today.
Yeah, and I think you're going to start to see a lot of other commentary out there, similar in that same vein from some of the big heavyweights out there. We do get the closing bells here, and we should point out this day could have been a lot worse. It is a bad day, a bad week here, but we are well off the lows of the day. The Dow Jones Industrial Average had been down more than 800 points. It's going to settle somewhere down around 470 points, give or take. That's a drop of about 1.6%. The S&P 500 is going to close down by about 65 points or 1.7% at that 3693 level. The NASDAQ composite is down 199 points or 1.8%, while the Russell 2000 for another day is the laggard, down about 2.5% here on the day.
Yeah, like you said, Romaine, it could have been a lot worse. At one point in the day, I looked at the companies that were advancing versus declining in the S&P 500. Fewer than 20 were actually in the green. We're finishing the day with 67 in the green, 436 lower on the S&P 500, Taylor.
Yeah, take a look, Tim, at where we are when you think about some of the individual sectors. For our radio audience, even the best performers, no green. It's just less red than it is down at the bottom. So even the best performers, some of the pharmaceuticals, some of the household products, you're still off about 0.5% on the day. That just shows you the breadth and depth of the selling that was underway today. I take you to the bottom of the screen. A lot of this is banks, it's transportation, it's food and staples, it's auto components. Those are off 2 to 4.5%, Katie. And then energy, you're off 6.7% on a day that we broke through 80 on crude.
I did find some gainers, a lot of analyst action out there. I want to start with Domino's Pizza. I really liked this one. It was upgraded to outperform from market perform at BMO against the backdrop of lowered near-term expectations. The analysts think that they see attractive risk reward there. I feel like that's a life lesson. If you just lower your expectations, suddenly there's a lot of opportunities. That was worth a 3% rally. Sherwin-Williams, too. Tim mentioned earlier that the home builders are outperforming today. That's definitely the case with Sherwin Sherwin-Williams. It was up as much as 2.4%. Looks like it managed to squeak out a gain of about 1.5%. And Twitter, I wanted to highlight this one because it was a brutal day for tech. Twitter escaped the worst of it. You had Wells Fargo analysts come out and say that they still expect the acquisition of Twitter by Elon Musk to successfully close. That's after the analyst there held a call with an expert in the Chancery Court.
All right, you got the gainers, Katie. Let's take a look at the decliners, rounding out the S&P 500. Today, APA Corporation, energy by far the worst performing sector today. This is WTI, fell below $80 for the first time since January. APA dragging down the sector on a percentage basis, the worst performer in the S&P. Cruise operators, again, taking a hit today, along with other travel-related stocks. Let's take a look at Carnival Corporation, down 7.1% today. A trio of concerns. You've got the recession fears, you've got hurricane activity, and of course the mobilization of Russian troops weighing on the sector. Carnival Cruise down about 17% just this week. Worst weekly performance since the week that ended July 1st when it fell 19%. And then Yeti Holdings finishing the day down by a little over 4%. We're talking Yeti Coolers. The company announced the resignation of the CFO, Paul Carbone, effective October 28th.
All right, and we just need to go back to just some of these broad market levels with the S&P closing down at its lowest level since June 17th. We talk about how it did re-enter, guys, that bear market territory, that 20% threshold on Wednesday, and it stayed there. I thought it was interesting that the Dow Jones Industrial Average traded at that 20% threshold, but did actually manage to close slightly above it, so not quite officially a technical bear market, but you got 148 names right now in the S&P 500 that are at those 52-week lows. And then, Caroline, you talk about what happened overseas a little bit earlier today with the stock 600 also hitting into a bear market.
And maybe that's what really amplified that anxiety that pushed us into this risk-off tone. That means, from an FX perspective, you dive into the haven that is King Dollar, and you certainly pull out of a weaker Great British Pound. Look at this FX movement here, 3.5% lower in the pound versus the dollar. We're seeing weakening to that extent. We're now at $1.08. So clearly a 37-year low. We haven't seen these sorts of levels on the British pound in so many decades, and we thought it was just the yen that was giving away to weakness. The pound very much front and center. We're seeing Bloomberg Dollar Index, as I say, hitting a new record high. Is this risk aversion? This is actually, in some way, the PMI data that we got looking stronger than expected as well. It is a sea of red in the rest of the FX space, so the euro weakening by 1.5%. Remember, next week we hear from a barrage of central bankers, Christine Lagarde among them, of the ECB, and it was really a cross-correlation sell-off at the moment. We see cross-asset sell-off, commodities off by more than 5% on WTI crude. We saw, of course, Brent crude selling off by 4.3%. Again, the strength of the dollar weighing into that and a worry about global growth. We see, interestingly, 4 straight weeks of losses in oil. That is the longest losing streak that we've had on a weekly basis all year. And gold at a 2-year low as we see the whole of the world basically start to get more hawkish, all apart from Turkey and maybe China. I'm looking at what's happening in sovereign bonds, and boy, oh boy, what a move in terms of the UK gilt market. 50 basis point move on the 5-year, never seen in history. Taylor.
I could probably do the next month on yields and be happy if it were up to me. As Caroline mentioned, this was a global story. It started with Australia, where yields go double digits. Then it goes on over to Europe, even some of the classic sort of safe havens, even German. And then you go down to Italy and Caroline's UK, and you're looking at 30 basis point moves on sort of that 10-year range. And then you come back to the US, and the significance feels less because we are only rising 7 basis points, except that you're now rising for 12 straight days, which is the longest streak on records. We're surpassing some of the streaks that we had in the 80s during the Volcker era. And it has just been relentless. A chart of this, Romaine, it is like a log chart, wow. Straight up. And it's pretty unbelievable. When we think about rate of change, 350 just a week or so ago, and now a 420 on that 2-year yield.
Yeah, we talked about that 30 basis points that we got this week. We had that also last week, and I think that adds to 17 that we had a little bit a while ago, a 10-year real yield. I don't know if you mentioned that, but at 1.3, we're back to the highest that we've seen on that going to 2011. And just real quickly, I want to point out something that Katie talked about a little bit earlier, was the volume here. I was just taking a look. I mean, when you look across the tapes, not just the S&P, 13 billion shares, more than 13 billion shares. So busiest day of the week, and the only day that really surpassed it in recent memory was last week, which of course was a triple witching when you had 17 billion shares swap hands.
And I guess some of that has to be expected when you think about how low volume was in the summer. But again, to see this type of volume on a Friday into selling has to be some sort of signal, at least according to the analysts that I've talked to, again, that there is actually some muscle behind this drawdown that we're seeing today. There is some conviction here.
Well, let's push ahead to next week and think about what we have coming up. Quite a bit of data on the housing market, and I'm expecting that we're seeing it going to continue to cool here in the United States, Caroline. And then, of course, it is the end of the quarter when we start to hear from companies and whether or not they're going to revise their guidance for the current quarter and the year and into next year as well.
And we still get the last dregs of what was the previous earnings, and we get the Nikes of this world. What are we getting from a picture of China? It was an interesting conversation we had with the CEO of Qualcomm a little bit earlier, just talking about the weakness you continue to see in that part of the world. We get the Microns of this world. We're going to be looking at what happens in terms of chip sector. You get a read from Bed Bath & Beyond as well. Let's talk a bit about memes.
Are they still going?
Yes.
Oh.
Still going now.
Wonderful. And just real quick, we also get a ton of Fed speak here. I was just looking, Bloomberg did the count here. 13 unique Fed speakers will take the stage at 22 separate events. And that's just the Fed members. You got all the ECB members out there, Risk Bank, I mean, I don't know.
The BOE
we made a joke that we're out of the quiet period. So the news is we'll start to hear from them again as we count down to November, which is on the horizon.
That should completely clear things up.
Well, it'll be interesting to hear if they stray at all from the message coming from Jerome Powell. They've really been talking in lockstep for so long now. Maybe it turns into a game of who can be the most hawkish, but seems like everyone is just taking their message from the chair right now.
All right. Well, it gives us plenty to think about for the entire weekend. That is going to do it for our cross-platform coverage of Beyond the Bell. We are going to see you all back here on Monday. Have a great weekend, everyone. We'll see you on Bloomberg TV, on Bloomberg Radio, and on YouTube. Same time, same place on Monday.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld live in the Bloomberg Interactive Brokers studio. Katie, it could have been worse, but it was still pretty bad. Here's an interesting fact. We are down quarter to date only, and I say only because we're almost back to where we started, down 2.4% on the S&P, down 3.9% on the Dow, and down 1.5% quarter to date. There's still a little bit more of the quarter to come, though year to date we are clearly in a bear market right now with the S&P 500 down more than 22.5%.
The quarter stats are interesting because it reminds me we had a big rally this summer. There was a lot of talk of a pivot. There was a lot of optimism out there.
It came and went.
It came and went. Well, Jerome Powell made it pretty clear that that was not happening.
Do the Feds? So that's a good question, right? With all these Fed speakers that we have coming up next week, do we actually see them stray at all from what we heard from Fed Chair Jay Powell?
I don't think so.
I think the concern, I don't know. I think the concern would be less, that it's more hawkish, and more sort of the concern would be maybe signs of easing with the tightening of financial, the easing of financial conditions.
I am going to be interested to see if there's any sort of clue, any sort of crumbs that they give about how they feel about the market reaction. Because remember, Joe Weisenthal and Tracy Alloway spoke
of the Odd Lots podcast?
Of the Odd Lots podcast. They spoke to Neil Kashkari of the Minneapolis Fed after Jerome Powell's Jackson Hole speech.
Speaking of hawks.
Markets absolutely puked in the aftermath of that. And Neil Kashkari said that he was happy to see that.
Right.
So
I love
he
that.
really explicitly said it. So I don't know. Will they be as bold, the just stable of Fed speakers we have coming up?
And I was
13?
being facetious. Yeah, that's right. I was being facetious when I said, speaking of hawks, because Kashkari, of course, known for his dovish stance. But when he says he's happy to see that sell-off, then, it signals something.
I want to make, a tiger can't change its stripes. A bird can change its feathers, though.
Yeah, you had a bird in college, right? Several birds.
I had 2 birds in college.
You can go ahead and make that joke. I want to bring in Jess Menton, though, who's standing by right now. She covers equities here at Bloomberg. Jess, what are you keeping an eye on as you wrap the week here with S&P 500 that fell 1.7% just today? And then look, in the past week, 4.6% to the downside, 4% on the Dow, and more than 5% on the NASDAQ.
Well, it looks like overall, when you're looking at the broader U.S. equity market, September has lived up to its reputation as being the worst month historically. And especially just today, from a technical perspective, I know everyone was keeping a close eye on the 3666 level. That's where the S&P 500 had closed on June 16th. We did breach that briefly, but did close actually above that, which is important as far as, so really technically, I guess those June lows are in place. You could argue that, but we're not too far above that right now.
I was surprised by this, Katie.
Were you?
And Jess. I don't know who wants to answer this. Maybe I'll ask Jess.
Maybe we can have a conversation.
Well, this surprised me because I thought that when we'd hit 36.667 and go below, that we'd see it trigger some selling for stop losses.
Yeah, and I think a lot of people were assuming that happened, but there's been many times, especially over the summer, where when we've been around these different technical thresholds that we'll see it happen intraday, but then, as a lot of traders will say, it really matters where we do close for those levels. And it'll be really interesting to see, especially heading into next week, what's in store. And actually next Friday, we will get the PCE indicator for inflation. That's usually the Fed's preferred gauge to measure it. But typically when those indicators have come out, the market hasn't been as volatile as, say, when you see these CPI numbers. So that'll be key next week. We also get those consumer spending reports. But I know Tim likes this. There's going to be a parade of Fed speakers that will be coming out next week.
I like a stable. I'm trying to find as many equine references. But there is a ton of them.
And Powell actually, he's supposed to talk about digital currencies on Tuesday, but
Oh,
we shall
let's
see.
go.
There was a Fed
Not
listening.
the priority right now, right?
There was
Not your priority.
There was a Fed listening event this afternoon Powell was speaking at, but he did not make any sort of indications or comments when it came to the rate picture, so we didn't get a lot of elaboration on that. But I know Tim will enjoy next week when we do hear from Fed speakers, and they will be throughout the week, so that's going to be really key looking ahead to next week. And also the final week of the third quarter, and because of the losses that have happened this week, it wiped out all the gains that we would have had since the start of July. And so now, if those losses hold, it would be the third consecutive quarter of losses.
A brief, sweet dream, those gains. Let's talk about the VIX. I don't know what's going on. It's higher today, for sure. It's still below 30. Is something broken? Can you help me?
So the VIX did spike at its highest this year around 36 in March, and that's been the head scratcher for so many different analysts that I've spoken with this year. As far as when you're looking for those signs of capitulation, they were always saying we need to see it spike higher. Also looking at those equity put call ratios spiking higher. So even though we're seeing it a bit more elevated, still not quite at the levels that analysts were looking at. But I did a taking stock about this recently, where
and that's a column.
It is a column.
How does that work? Hold on. Is there someone new every day who writes that, or do you have a certain day that you do it, Jess? Because sometimes I'll read it
Elena
and I'll
Papina and I switch
So
off.
good. You
She's
guys
great.
are so good.
She's great.
It's a great column. It's a great way to start your day.
I've written it a few times.
Oh,
It
I
was
didn't know
not
that, Katie.
good. Yeah.
It's what?
It was not that good.
I'm sure it was good.
Thankfully,
Okay,
then
I'm-
Jess joined Bloomberg.
I'm sorry. I'm really sorry that I got you off track here, Jess.
No,
Go
it's
ahead.
great.
You wrote
No.
about this recently.
No, Elena Papina, she's really great, and she had a bunch of great ones on options earlier this week and hedge fund trading. But looking more toward what's happening with the VIX, more of the moving average when you're seeing the VIX where it is compared to, say, the dot-com bubble and around the housing crisis, it's actually a bit more elevated and has stayed at more elevated levels than, say, those periods were before they did spike above 40. So that to me was interesting because you can't really see those volatility measures if you just look at the VIX. If you look at, say, 1% swings in either direction this year, at a particular point earlier this summer, Strategas actually had some data that showed it was at the highest levels since around 2008. So you can see those volatility measures in other corners when you're looking at it, but it's not quite as stark when you're just looking at the VIX.
Okay, so when can we say panic, though? I used that word on the simulcast. Romaine Bostick gave me a hard time.
Why?
I didn't have a good comeback. Help me.
I think something that's key, and especially with today's movement, when we're looking at what's happening in energy, because that clearly was the winner. And we were looking back toward the end of May, that sector had been up in the S&P 500 almost 60%, now down about 30% for the year. I mean, not down 30%, it's up a little under 30%, but clearly giving up more than half of its gains at a certain point from earlier this year. And so the big thing when it comes to the argument about capitulation, and especially analysts at Bloomberg Intelligence, when I'm talking to Gina Martin Adams and Jillian Wolfe, it's more, when are you going to see those signs when investors are giving up this year's winners? And we started seeing a trend in the middle of June, which was around the June lows, of when also that correlation when energy prices started falling, energy wasn't performing quite as well. And then we saw a little bit of a difference the past few weeks as people were moving back toward value. But when you're seeing big signs like this and investors are giving up those winners this year, that would give you an indication that we're taking a step closer toward capitulation.
Okay, Jess, help us move this forward just in the last minute that we have with you and think about what's coming next week and the following week. So the end of the quarter is on the horizon, but we also have Fed speakers next week. So what's sort of more important here? What we start to hear from companies and the big banks in a couple weeks, And I just want to throw in a little comment that we got yesterday from Frank Sorrentino, the chairman and CEO of Connect One Bank Corp, the CEO of a small regional bank. He said that consumers are still in a really good place right now, and they're starting to see some weakness, but I was expecting to hear from him a much more pessimistic view.
And we will get the latest consumer spending numbers for August next Friday. So that'll come in addition to the PCE indicators. So as you were talking about, obviously the last week of the quarter is really crucial, but also looking for whether or not these earning projections for the S&P 500 will become even lower. So looking at the third quarter, right, preseason estimates, they were close to about 10%. Now they're below 4% for the third quarter. But again, those 2023 estimates are still pretty elevated. So that's key to see how much further down will those estimates begin to come, because that's another sign that investors are looking for broader markets to capitulate. You need to see those numbers come down.
All right, Jess Menton, Bloomberg News Equities reported. Did you file your piece for this weekend yet?
So I'm actually leaving in a few hours on my way to
In a few
Ireland.
hours?
Oh,
Yes.
wow.
Oh, okay. I thought you might have.
Oh, okay, good.
No, I'm going to Dublin, so I'm very excited.
All those things that
How
she just...
long?
I'll be gone I won't come back until the following week, so I'm going to be gone all next week, which I'm very disappointed. I'm going to miss all this
don't
fun
do
market
that.
action.
Do not do that.
It's okay.
I'll keep up with it. I'll keep checking.
The Fed speakers will continue, and then earnings season happens. Jess Menton, Bloomberg News Equities reporter, really appreciate you joining us, especially right before vacation. Let's get over to Doug Krisner. He's got an update on what exactly happened today. Hey, Doug.
What happened was we had a sell-off in the equity market, Tim. We joined European stocks in moving sharply lower. This was after the British government delivered the most sweeping tax cut since 1972. If you're in the market, you got to be concerned with the risk of accelerated inflation as a result of these cuts. We already know that the Bank of England is struggling to rein in prices. So if the BOE has to be aggressive now, and there is speculation of a 100 basis point move in November from the Bank of England, the Fed has already said that it's trying to get the Fed funds rate to around 4.4% by the end of the year. Aggressive tightening really raises the risk of recession. Yes, we were down today, but we finished well off the worst point of the session. The S&P had been down at session lows nearly 3%. We ended off just 1.7%. Dow Industrial Average down 1.6% today, and the NASDAQ comp was weaker by about 1.8%. In the bond market, a move up at the short end of the yield curve with a 2-year rising 7 basis points to 419. At the longer end, we dip a bit. Maybe this is the market saying recession is more than likely. 10-year Treasury last quoted at 368. And the move up in short rates really strengthening the dollar, with the Bloomberg Dollar Spot Index up 1.3% today. I'm Doug Krisner. That is your Bloomberg Business Flash.
Hey, thank you so much for that update, Doug Krisner. Do really appreciate it. Well, there's some hard truths in this world. Steel is dirty. About 7% of global greenhouse gas emissions come from steel, but it's also the most used metal in the world. We need it, and right now we can't live without it. We have with us this afternoon Erica Chan, General Manager of Sustainability at U.S. Steel, a $4.4 billion company with a market cap of $4.4 billion. She's with us right now in the Bloomberg Interactive Brokers studio. Erica, it's good to have you with us. How are you?
I'm doing well. Thank you for having me.
Yeah, well, thanks for joining us. So how do we do this? How do we make the steel industry not responsible for 7% of global emissions?
Well, it's going to take a lot of things for that to happen. And the good news is that everyone is coming together to address this problem. So I'll give you an example of collaboration. Today, the Climate Aligned Finance with the RMI organization and several banks, including ING, launched the Sustainable Steel Principles. And this is designed to standardize how banks support and finance the steel sector in order to accelerate a decarbonization journey. So that's one of the ways. Another thing that we're doing at U.S. Steel in particular is, which is really unique, is that we've integrated sustainability into our business strategy. So everything that we do is integrated across our operations, across our enterprise.
Okay, I want to just step back because Katie and I were talking a little bit earlier about science, and she revealed to me
Oh my God.
that
What are you going to say?
has never taken a physics class.
No,
That's okay.
And it's okay.
Is it okay?
Did you take chemistry,
It's
though?
totally okay.
I almost failed the chemistry.
Okay, she almost failed chemistry,
Yeah.
but you're really good at writing about bonds.
Yeah,
She
I
knows
have
everything about crypto.
Some very specific talent.
But let's take a step back and talk about how steel is made and why it's so energy intensive. So take us through that. And Katie, I don't know why I threw you under the bus. I'm
no,
sorry.
it's fine. I should have tried harder in school. But how is steel made?
Yeah, well, I am not an engineer, but I will tell you, from what I understand, so, I joined U.S. Steel about 8 months ago, and I knew nothing about steel. I worked for Dell Technologies. But it's fascinating. Steel is made in one way, which is a traditional way of integrated steel making that's been done for over 120 years, where you have a blast furnace, a lot of ingredients are poured in, and then you've got liquid iron coming out, and eventually steel. But the newer technology uses what is called electric arc furnace technology, and that is what is referred to as mini mills. And that has a lower carbon footprint, up to about 70 to 80% reduction in carbon footprint for steel. So one of the interesting things about steel is it's infinitely recyclable. It loses none of its properties. And so I like to say that...
Is that energy intensive, though, to recycle it?
No, we actually use it as an energy source. So up to 80% of scrap steel can be used in our electric arc furnaces. So we've been practicing circular economy before circular economy became a thing. We recycled last year over 5.2 million tons of steel and scrap.
And so if I look at your notes, this stat really jumped out to me, that steel is, of course, an emissions-intensive sector, accounting for roughly 7% of global greenhouse gas emissions globally. And again, I'm a little shaky on the science, but the process you just described, what's realistic if we think about where that 7% could go to?
So, it's going to take a combination of things. We know we can't do it alone, right? One company can't do it alone. We've got to come together, and a lot of things have to happen, like government funding, policy to support it, improved regulations, and all of that. But I think that the really important thing on getting to that is exploration of technologies that can help us get there, like green hydrogen. Have you heard of green hydrogen?
I have heard of green
hydrogen.
We had Plug Power CEO Andy
I
Marsh
knew the
on our program, who works a lot with hydrogen and works with companies all over.
Yeah. So the availability of green hydrogen is going to help lower the intensity of steel making. A lot of other technologies like electrification, direct reduced iron with hydrogen, a lot of different technologies need to come to maturity, and carbon capture, utilization, and storage as well.
Earlier this week, we had on our program Dr. Andrew Forrest of Fortescue. And it's a holding company that owns a bunch of mines in Australia. And their competitors include Rio Tinto and more. And it's mining, so it's not necessarily the processing of it, but they're looking to decarbonize completely. What are your goals at U.S. Steel? And he's not talking carbon credits or carbon offsets here. He's literally talking moving completely away from fossil fuels in a real way.
Yeah, absolutely. And that's why we actually set last year our net zero goal. So we've committed to become net zero, so that's an absolute reduction in emissions, absolute emissions reduction by 2050. And we have an interim emissions intensity to go along the way, but that is the same spirit that we're taking. Is we have to invest and explore in the technologies and energy usage as well that will absolutely decarbonize our footprint. And we are not relying on carbon offsets to get us there, but there are a lot of things that we need, right, to support us in that journey.
Well, sit tight with us, Erica. We're going to be back with you in just a few minutes. Erica Chan, General Manager of Sustainability at U.S. Steel. She's with us right now in the Bloomberg Interactive Brokers studio. You're listening to Bloomberg Business Week, and this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stanovic and Katie Greifeld. In just a couple of minutes, we're going to be continuing our conversation with Erica Chan. She's General Manager of Sustainability at U.S. Steel. Just arrived there about 8 months ago. She was at Dell before that. We got much more to talk about in just a few minutes, though. Let's get an update on everything happening after hours. Here's Doug Krisner.
Hey, Tim, we had a wipeout in the equity market today. That's the bad news. The good news, we finished well off session lows. The S&P 500 had been down by nearly 3%. We finished off 1.7% today. A lot of concern about a global recession. The British government delivered the most sweeping tax cut since 1972. Markets are concerned here that this is going to engender a lot more inflation in the UK at a time when the Bank of England is already struggling to get prices under control. So there's speculation now that the Bank of England is going to have to raise rates next month by 100 basis points. You'll remember the Fed forecast earlier this week trying to get that key policy rate up to around 4.4% by the end of the year. So what are we looking at? Stateside, another 125 basis points in Fed tightening. That may produce a lot more recessionary pressure. Today, at the shorter end of the curve, a 2-year was up more than 7 basis points in yield to 4.19, but the longer end saw a decline in yield, a 10-year Treasury off about 3 basis points. We were last quoted at 368. The Dow today weaker by 1.2%. As I mentioned, the S&P down 1.7%. NASDAQ comp off about 1.8% today. But the dollar rallied with the Bloomberg Dollar Spot Index up 1.3%. The euro, though, down 1.5%, 96.91 U.S. cents. I'm Doug Krisner. That is your Bloomberg Business Flash.
Thanks so much for that update, Doug Krisner. Really do appreciate it. Let's get right back to Erica Chan, General Manager of Sustainability at U.S. Steel. She's with us right now in the Bloomberg Interactive Brokers Studio. So, Erica, I want to talk more about sustainability, of course, at U.S. Steel, and specifically about the plan to eliminate carbon emissions from steel production. Is it too early to completely, how do you guys completely comply with EAFs and go to mini mills that use all the scrap steel to remelt into new steel? Talk about how that works.
Yeah. So, we acquired Big River Steel, which actually was the first LEED certified steel mill in the U.S. And it's also the first U.S.-based steel site to be responsible steel certified. So that is our first electric arc furnace, along with one that we have for our tubular business in Fairfield, Alabama. So the journey there is that it's a combination of utilization of this improved technology for steelmaking, but as well as investing in technologies that can help actually decarbonize. So carbon capture, utilization and storage, that's one method as well. We talked about green hydrogen earlier. Electrification of the grid, because steel is so energy intensive, we need more renewable energy in the grid and a grid infrastructure that can support that expanded power need. So those are some of the ways that we're looking at it.
When it comes to carbon capture, with the current furnaces you have, the current blast furnaces, does that work? What research have you done there?
Yeah, so we actually have formed some partnerships and alliances we're bringing together in a non-competitive environment like peers and academia, as well as government agencies, to look at how do we scale and how do we implement that infrastructure, because it doesn't exist in a scale at a level that we would need, to cover all of the blast furnaces that are in operation today in the U.S.
What is the role of the government here? And to what extent does the U.S. government need to step in and actually help you and other American steel companies get to net zero?
Yeah, absolutely. I think we've seen a big signal from the government just in the past few weeks, right, with the IRA. And I think that's going to be a good first forward movement into making sure that the U.S. government enables the various levers that we need to decarbonize across a number of different industries.
And so what kind of relationship, what kind of conversations do you have with politicians, with the White House? What does that look like?
Yeah, well, we actually welcome engagement from policymakers on all levels, federal, we work very local in our communities as well. And it's looking at the policies that can enable like clean energy, right? Like renewable incentives for renewable energy infrastructure and development. So we do work with regulators and administrators and various agencies at a federal and state and local level.
Who are those regulators? Who are the politicians that you're actually speaking to on a regular basis?
So it's a number of different ones, and my colleagues who work in government affairs are, the ones who are the primary leads on that. In my role in sustainability, and I focus on looking at the overall corporate sustainability strategy and how do we meet our goals, how do we advance on our commitments to be more a sustainable company, to offer more profitable steel solutions for our customers, because our customers are really the ones who are also at the forefront of this, right?
Because in a sense that they're demanding
exactly.
it from you? Well, so how much of this is driven internally versus externally?
I think it's a good, healthy combination. So our customers have their own expectations, right? Their own commitments. Whether you're an auto manufacturer, an appliance manufacturer, you want to offer more sustainable products to your customers, and in order to do that, you need more sustainable materials, right? Whether it's steel or some other material that goes into making that.
And Erica, I want to talk a little bit about you and your role at U.S. Steel. You said that you joined 8 months ago. Where did you come from?
Yes. So I worked at Dell Technologies. I was also in corporate sustainability, and I worked there for over 11 years. So it was a really interesting journey to come over to the steel sector, which I knew nothing about. I'm not an engineer. I don't have a PhD in metallurgy.
Yeah.
I don't think I failed my physics class though. But
I didn't even take physics. I failed chemistry.
Oh, okay.
All right, Mr. Harris from my high school is listening to this, maybe, so he would know how I did. It wasn't so great.
Yeah.
So I do think that's really interesting that you went from Dell Technologies to U.S. Steel, sort of from technology to an industrial industry. Why that leap in particular?
So what I saw in U.S. Steel was the opportunity to join an iconic company that I saw was on a solid journey towards transformation, right? It's not just, I'm going to announce these goals and do nothing about it. There were solid plans in place and actions being taken. And so I wanted to be part of that. I wanted to, bring my practice around sustainability and my knowledge to kind of help evolve the foundation already that was there. And so, and I love a good challenge, so yeah.
We only have 30 seconds left, but you've been there for 8 months.
Yes.
How big have the changes been since you've been there? What can you tell us?
So culture-wise, it's different, right? Going from 150,000 global, company to a 24,000, I think I'm going to get the stat right, employee worldwide, both U.S. and Slovakia. And what I found is that it is a very warm and embracing culture. We've had employees who have worked there like for multi-generations, like for 4 generations. And that is something you really don't see in corporate America today. So the environment has been very warm and welcoming. So it's been a really great experience.
Well, please do come back and join us once again when you are back in New York City. Very pleased to have with us Erica Chan, General Manager of Sustainability at U.S. Steel, with us in the Bloomberg Interactive Brokers Studios in New York. To Washington, D.C. we go for world and national news with Nancy Lyons. Hey, Nancy.
Thanks, Tim. House Republicans are promoting their agenda ahead of November's crucial midterm elections. They held a rally today in Pittsburgh to talk about the Commitment to America plan. House Minority Leader Kevin McCarthy says they're going in a new direction that's based on freedom.
Our job is to work for you, not go after you. Our job is to make America stronger.
McCarthy's 4-point plan prioritizes illegal immigration, the opioid crisis, combating crime, and increasing fossil fuel production. President Biden says he believes what's most telling about the GOP plan is what was not mentioned.
In the course of nearly an hour, here's a few of the things we didn't hear. We didn't hear him mention the right to choose. We didn't hear him mention Medicare. We didn't hear him mention Social Security.
Biden also accused many Republicans of hypocrisy for praising police while defending rioters who assaulted police during last year's Capitol attack. British Prime Minister Liz Truss is shaking up the British economy by introducing the most sweeping tax cuts since 1972. Bloomberg's Lizzie Burden has more on the reaction.
Markets reckon it's going to add to inflation. That's why traders are now pricing for 100 basis points from the Bank of England in November. Secondly, it's clearly going to necessitate a lot of borrowing. The Institute for Fiscal Studies says while it's going to add to borrowing, it won't necessarily stimulate growth significantly.
Bloomberg's Lizzie Burden in London. The package was more ambitious than expected. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stanovic and Katie Greifeld were live in the Bloomberg Interactive Brokers studio in New York. Interesting story on the Bloomberg terminal about a newly minted billionaire. A SPAC deal making the founder of a conservative social media platform a billionaire. And it's not Donald Trump.
It's not Donald Trump. In fact, it's Chris Pavlovski. He is the CEO of Rumble. It's worth more than $1.8 billion after the lightly moderated video network, which features daily shows from hosts including Glenn Greenwald and Russell Brand. It went public on Monday. It merged with a blank check firm led by Cantor Fitzgerald's Howard Lutnick. Do you know what Rumble is? Have you used it?
I've never used it.
No.
I've heard of it. I didn't know that they had daily shows like this. That's interesting.
That is
so it's like a
interesting.
YouTube on like a lightly moderated version of YouTube?
It sure as heck sounds like
Okay.
it. Apparently, it gained popularity after the 2020 U.S. presidential election when many conservatives became frustrated with content moderation by large tech platforms such as Alphabet's YouTube, which they said unfairly restricted speech around topics including the pandemic and the January 6th Capitol riots.
All right. Rumble reported 41 million monthly active users in the first quarter of 2022. It's, quote, on a mission to protect a free and open internet, according to a filing with the SEC. The company's headquartered in Toronto as well as Longboat Key, Florida. Did not respond to requests for comments. I do wonder, Katie, first of all, it's not the only sort of SPAC that, is looking to take an existing technology but have it lightly moderated, right? You have Truth Social, Digital World Acquisition Corporation, which was set to merge and is set to merge with President Trump's platform. And that one has gone quite differently than this. This one's like a rare example of a successful
This is
SPAC.
a really bright spot. I mean, it's been a really rough time for SPACs. Just this week, you had Chamath Palihapitiya. He was known as the SPAC King. He shut down 2 of his SPACs.
This is Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
So stock markets in both the U.S. and Europe sold off today, and the trigger was the British government delivering the most sweeping tax cuts since 1972. There is already the concern in the U.K. that the Bank of England is going to have to move aggressively to rein in prices. So when you get tax cuts like this, the concern is much greater inflation and a much more aggressive BOE. Remember, earlier this week here in the States, the Fed was forecasting a move up in its policy rate to 4.4% by the end of the year. So whether it's aggressive tightening coming from the central bank in the UK or the Fed, we're talking about a greater risk of global recession right now. That said, the equity market was down today, but we finished well off the worst level of the session. The S&P had been down by nearly 3%. We finished off 1.7%. Energy leading this decline. Crude oil in New York now in the electronic session, the extended session, is down 5%, 79.38 in WTI. The Dow today down 1.6%, NASDAQ comp off about 1.8%. We had a move up in short-term rates. Two-year Treasury last quoted at around 420, so we're up nearly 7 basis points on the day. At the longer end, the market really discounting the probability, the higher probability of recession going forward. So we're down in yield on the 10-year to 368 with a loss of about 3 basis points. But it was a winning day for the dollar. The Bloomberg Dollar Spot Index jumping 1.3%. I'm Doug Krisner. That is your Bloomberg Business Flash.
Hey, thanks so much for that update, Doug Krisner. Really appreciate it. Well, you've probably heard of our next guest, or at least seen his videos on YouTube. He hosts the Mindscape podcast. He's also a best-selling author of several books, including From Eternity to Here and a few more. He's the author of the new book, The Biggest Ideas in the Universe, Space, Time, and Emotion. We're talking about Sean Carroll, professor of natural philosophy at Johns Hopkins University. Joins us right now on the phone from Harrisburg, Pennsylvania. Sean, how are you?
I'm very good. Thanks for having me on.
Yeah, it's really great to have you join us this afternoon. Your new book, The Biggest Ideas in the Universe, Space, Time, and Motion, it goes through things that I think a lot of people would find really complex or they'd find intimidating. I mean, we're talking space, time, black holes, gravity, things that aren't necessarily easy to explain. But you're known for explaining those really complicated things. What is the key to explaining something really complex?
Well, I think the key is to remember what it's like to not know it. You know, when we learn something, when we become an expert, we know how to do it, whether it's playing the guitar or doing theoretical physics. And sometimes you just want to say, you know, just understand it, just be like this. But you have to remember what it was like and therefore try to lead people on the journey from not getting it to getting it.
Well, as we've talked about already on this program, I've actually never taken a physics class. I made it through high school. I made it through college. I made it through grad school. I don't know
what type of school you went to that allowed you to retire without, or graduate without taking a physics class.
It is nuts, but I swear I have a diploma. I find physics a very scary topic. I've never even taken a basic course in it. So when you have people such as me who maybe actually did take intro physics at some point in their life, I mean, how do you get them interested in a book like this? How do you make it accessible?
Well, this book in particular is trying something very, very audacious and experimental, which is to try to fill in the gap between ordinary popular books and textbooks. So the difference is that if you want to read a textbook, if you want to become a professional physicist, you know, you have to do a lot of problem sets, you have to do a lot of homework. And what I'm able to do, or I'm trying to do, is to actually tell you physics for real with the equations, but assuming that you start with no mathematical knowledge at all. And the trick is I don't make you do homework. We focus in on what the equations mean rather than trying to solve them. So I think it helps give people a new way of looking at the universe they couldn't otherwise get.
Do you find it going from doing this on YouTube, because you are known for your YouTube videos as well, do you find it more difficult to actually explain things in a book than over YouTube? Or is it kind of a similar translation of tasks here?
Well, that's actually a great question, because I think it's just different. I think that neither one is especially easier or harder. I mean, I also have a podcast, which is entirely audio, which is a whole nother set of challenges. But different people learn in different ways and they respond differently. And I think that's good. That's a feature, not a bug. This book is not going to be for some people because they don't want any equations. They just want some pictures and some stories, and that's great.
You're
but
talking
for
about
many
me.
people, yeah, maybe. I don't know, but you never try. You never know until you try
That's
it.
true.
And the YouTube is great because you can see someone's face and you can hear their voice. But the book is great because you can go into more details. You can be more careful. I think we need them all.
I'm wondering how you translate this in the classroom. You are, of course, professor of natural philosophy at Johns Hopkins University. How does doing stuff like this make you a better teacher?
Oh, it's absolutely helpful to really spend serious time thinking about why certain things are true. When you take a class for the first time, you're told something, you got to move on because there's going to be an exam. You can't wait and think about why exactly it is true. You take for granted that your professors are telling you the truth. When you sit down to write a book about it, you better be sure that you have a good reason for saying everything you do.
Okay, I got a fun thing we can do with Katie because she didn't take physics.
Hit me.
So, Sean, I'm going to ask you to explain a concept from the book. I'm going to let you choose, dealer's choice here. Explain it to Katie here in just a couple of minutes, if we can do that.
Sure.
The biggest idea.
I can explain space-time. How about that?
Okay, I will need this explained to me as well.
So this is an idea. It stems from Albert Einstein. It was actually his old university professor, Hermann Minkowski, who put it down in a complete form. And the idea is that when you travel from one moment of time to another, and one from point in space to another, the time that you experience, on your wristwatch or whatever, is like a distance you travel in space. In the sense that if you travel between 2 points in space, the actual distance that you move will depend on the path you take, right? There's a shortest distance, straight line, but there's also longer curvy lines that give you a detour and take longer to get there, right? Time is also like that. And so two people can start at the same point and meet up some later time at the same point, having experienced different amounts of time because they moved through the universe differently. And in the book, I will give you the equation that lets you understand that.
That wasn't even a couple minutes. You did that in 1 minute.
I feel like I'm
I
spiraling. I feel like I should just read the book, probably.
You definitely should read the book.
I'm more of a visual learner than audio, which is a little bit funny because we're anchoring radio right now. Yeah.
Hey, Sean, tell us a little bit about something that you learned actually writing this book, because, I think a lot of people would think going into something like this, you're a professor of natural philosophy, so you probably know all this stuff already, but I'll never forget an English teacher who told me in high school that you don't actually know something until you're able to explain it.
Well, that's absolutely true, but I'll tell you that the actually most enjoyable things that I learned while writing the book are the little historical anecdotes along the way, because you're never taught that when you take physics or math, that you just taught the material. And so reading about people like Einstein and Riemann, who invented Riemannian geometry, and the bitter rivalries between Isaac Newton and basically everyone else alive at that time, it was really just a great reminder that all these great ideas come from human beings with all the usual worries and ambitions that we have.
Okay, Sean, 30 seconds left here. You've written a lot about space. Are we alone in this universe?
I hope not, but I don't know. We might be. And if we are, that's just more reason to take care of the universe that we have.
All right, that's a really good answer. Sean Carroll, professor of natural philosophy at Johns Hopkins University. He's the author of many books, the newest, The Biggest Ideas in the Universe, Space, Time, and Motion. He joins us this afternoon via Zoom from Harrisburg, Pennsylvania. Worth checking out how the markets closed on this Friday, the final trading day of the week. Down 1.7% on the S&P, down for the last 5 days on the week, 4.6%, 4% on the Dow, and down for the week on the NASDAQ, 5%. A big thank you to the entire team here at Bloomberg Business Week and at Bloomberg Radio for listening, and thank you to Katie Greifeld for filling in these last couple of days. Carol Masser will be back on Monday. I'm Tim Stenbeck, and this is Bloomberg.